When Wall Street collapsed in 1929, everyone said, the system is broken. But 6 years later, when the world went to war again, that same system was financing the largest weapons factory in history. It hadn't broken. It had just changed owners. 1913, Washington. Secret meeting, Jekyll Island. A handful of bankers and politicians drafting a law, the Federal Reserve Act. The official story: prevent panic, ensure stability. The real mechanism was far sharper: centralise the power to print money. Until that day, thousands of banks could issue their own banknotes. The system was scattered, uncontrollable. The new law created a lender of last resort. Whoever controls money controls crisis, and whoever controls crisis reprices everything. Here's the mechanism. The central bank lends to the government, takes bonds in return. A bond is a promise. I'll pay you in the future. But the central bank makes that bond a balance sheet asset, prints new money against it. The government pumps that money into the economy. Military, infrastructure, salaries. Money enters circulation. But since this money is born from debt, it carries interest. To pay the interest, new debt is needed. New debt, new money, new interest. The cycle feeds itself. In the 1920s, the US turned this cycle into a consumption boom. Credit got cheap, markets soared, everyone thought they were rich. In 1929, the music stopped. The debt pile collapsed, banks failed, unemployment hit 1 in 3. Roosevelt built a new game, Gold Reserve Act, 1934. He confiscated gold from citizens, unilaterally raised its price, gave the dollar reserve status. Gold was now backed by state power, not the free market. Who won? Bond-holding institutions. The central bank's balance sheet was zero in 1913. By 1945, it was $50 billion. That number meant interest income locked into government debt. After every crisis, the government borrowed more, the central bank bought more bonds, the cycle deepened. Who lost? The average citizen holding cash savings. Inflation silently eroded their wealth. $1 in 1913 had the purchasing power of roughly $30 today. A century later, that dollar is worth 3 cents. A 97% loss. But the official narrative always said stability. Among nations, the winner was clear, the one issuing the reserve currency. After World War II, the Bretton Woods Agreement pegged the dollar to gold, other currencies to the dollar. The US could lend to the world, buy goods in return, run deficits forever, because it could pay its debt in currency it printed. When Nixon ended the gold standard in 1971, the system became purely trust-based. No physical asset backed our money anymore. Only military power, technology, and habit. Now the invisible part, the system was never designed to rescue. Crisis is a feature of the mechanism, not a bug, because every crisis resets asset prices, bankrupts debtors, allows creditors to buy cheap. In the 1930s, it was real estate. In 2008, mortgage portfolios. In 2020, small businesses. Bailout packages always flow in the same direction, upward. The truth beneath too big to fail is that failure is reserved for the small. Second twist, inflation isn't a tax, it's a transfer. When government prints new money, your money's purchasing power declines. That loss doesn't vanish into thin air, it transfers to whoever spends the money first. This is called the Cantillon effect. First receivers, government, banks, large contractors, shop at real prices. By the time it reaches you, prices have already risen. This is why inflation is a hidden wealth transfer. Today, the same cycle is spinning. Central bank balance sheets have grown tenfold since 2008. Under the name quantitative easing, trillions in bond purchases were made. Interest rates dropped to zero, sometimes negative. Negative interest means, I pay you for lending me money. Absurd? No, the system now runs not on growth but on the debt cycle. Debt doesn't finance growth. Growth finances debt. History's lesson is clear. Money is never neutral. Whoever creates money, whoever sets its value, Whoever manages crisis, that's where power lives. Beneath free market rhetoric, there's always a central authority. That authority turns crisis into opportunity because crisis is a redistribution moment. Winners are those who positioned beforehand. Losers are those who believe the system was fair. History doesn't repeat, but it rhymes. Those who read the cycles, who see the mechanism, are always one step ahead. If you want to decode these patterns, subscribe Financial History Chronicles, because the next crisis is already being written.